Have you ever done the real math on your life? Not the math on a spreadsheet, the math of how your time is being exchanged. You wake up early, you spend part of your morning getting ready, you travel to work, you give 8 hours of focus, stress, energy, and attention, then you travel back home. By the time the day is finished, 10 hours of your life have been spent working for money. That is how most people live. But then ask the question that most people avoid. While you are working for money, what is your money doing? For many people, the answer is painful. Their money is sleeping. It sits in a checking account. It sits in a low-yield savings account. It sits inside a bank where the return barely keeps up with nothing. They work all day while their money lies still. They get tired while their money does not move. They face inflation, bills, and pressure. While their money quietly loses purchasing power, that is not a fair system. And when I look at money, I always try to look at the machine beneath the surface. The visible thing is the paycheck. The hidden thing is the system that determines whether that paycheck becomes freedom or disappears into the cost of living. Most people focus only on earning. But earning is only one side of the machine. The other side is allocation. Where does the money go after it enters your life? Does it disappear into spending? Does it sit idle, or does it begin to work? That is the question that changes everything. I am not talking about becoming a day trader. I am not talking about sitting in front of a screen trying to guess which stock will move tomorrow. I am not talking about chasing excitement, reading every rumor, or trying to become smarter than the market in one afternoon. That is not investing. That is usually emotion wearing the costume of intelligence. What I want to talk about is much simpler. It is the way I would think about the first meaningful pool of capital. And the number I want to use is $10,000. $10,000 is not enough to retire. It is not enough to change your whole life overnight, but it is enough to build a system. And once you have a system, you have something much more important than a single sum of money. You have a process, you have a machine, you have rules that help you make decisions even when your emotions are trying to take control. That is what most people are missing. They are not missing intelligence. They are not missing opinions. They are missing a system when you have $10,000. The worst thing you can do is treat it as a lump of money that must make you rich immediately. That creates pressure. Pressure creates impatience. Impatience creates bad decisions. Bad decisions destroy capital. The better way is to treat that $10,000 as the beginning of a long-term machine. Your goal is not to make the money exciting. Your goal is to make the money useful. A good investment system should not feel like a casino. It should feel more like a washing machine. You decide the settings, you press start, then you let the machine do the work while you go live your life. That is the basic principle. Make your money work for you instead of spending your entire life chasing money. Now, before we get into the actual structure, there are 3 wrong ideas that keep people stuck. These wrong ideas are powerful because they feel reasonable. They are repeated by friends, family, banks, and sometimes by your own fear. But if you look at the cause and effect chain, you will see that they do not hold up. The first wrong idea is that investing is dangerous and saving is safe. At first, this seems logical. You look at the stock market and you see prices moving up and down. You look at a bank account and the number looks stable, so your brain says the bank is safe and investing is risky. But you must ask a deeper question. Safe from what? If you mean safe from short-term price fluctuation, then yes, cash looks safe. But if you mean safe from losing purchasing power, then cash is often not safe at all. If inflation is around 3.3% and the national average yield on a 1-year deposit is around 1.9%, then the math is not complicated. Your money is losing real value. It may look unchanged on the screen, but its buying power is shrinking. That is one of the most deceptive things about money. The number can stay the same while the value falls. You can look at $10,000 today and still see $10,000 next year. But if the cost of food, rent, transportation, and everything else has moved higher, that $10,000 is not the same. It buys less of the world over 10 years. That same $10,000 can fall to something like $8,700 in real purchasing power if it is left in a place where inflation outruns the yield. So the question is not whether the number is stable. The question is whether the purchasing power is protected. That is why I do not think of saving and investing as opposites. I think of them as different tools with different jobs. Cash gives you stability. Investing gives you growth. If you use cash for growth, it fails. If you use investing for emergency stability, it can fail. The key is not choosing one forever. The key is putting each tool in the right place. The second wrong idea is that you need a huge amount of money before investing matters. This is another belief that keeps people from starting. They say, I only have a few $1,000s. I will wait until I have more. I will wait until I have $50,000. I will wait until I have $100,000. I will wait until life is more stable. But waiting is often the hidden cost. $10,000 is already enough to begin building the machine. It is like going to the gym. You do not refuse to train because the dumbbells are only 10 pounds. The purpose at the beginning is not to lift the heaviest weight in the room. The purpose is to learn the movement, build the habit, and develop the identity of a person who trains. Investing works the same way. At first, the amount matters less than the process. You are learning how to allocate. You are learning how to stay consistent. You are learning how to think in years instead of days. You are learning how not to panic. Those skills become extremely valuable when the numbers become larger. A person who cannot manage $10,000 calmly will usually not manage $100,000 calmly. The size changes, but the psychology does not automatically change with it. That is why the first meaningful system matters so much. The third wrong idea is that investing means staring at charts and doing constant research. For a professional investor, research is part of the work. But for most people with jobs, families, and responsibilities, trying to act like a professional trader is usually a poor use of time. You can spend 3 hours trying to find one stock that will outperform, or you can use those 3 hours to improve your skills, increase your income, strengthen a relationship, rest, or build something useful. The whole idea of passive investing is based on humility. It says, I do not need to outguess the whole market every week. I can own broad pieces of the market. I can diversify. I can keep costs low. I can rebalance. I can let time do what time does. That is not laziness in a bad sense. It is a disciplined form of simplicity. A lot of people make investing hard because they want to feel clever. But cleverness is not the goal. Results are the goal. A simple system that you can follow for 30 years is often better than a complicated system you abandon in 6 months. Now let us come back to the $10,000. Why do I emphasize that number? Because $10,000 is a psychological threshold. When your account reaches 5 figures, something changes. Not because the money is large enough to solve every problem. It is not. But because it is large enough for you to feel the first real sense of financial gravity. If you earn a 6% annualized return on $10,000, that is about $600 a year or about $50 a month. $50 a month will not make you rich, but it is different from a paycheck. A paycheck requires your time. This $50 is different. It is generated while you sleep. It is generated while you are walking, resting, spending time with family, or taking a day off. It is the first small proof that capital can work without you standing beside it. That realization is powerful. The first dividend, the first interest payment, the first automatic growth from an investment account can feel small in dollar terms but large in psychological terms. It tells you that money can become a worker in your system. And once you understand that, you stop seeing money only as something to spend. You begin to see it as something to deploy. That is a very important mental shift. People who never experience that shift remain trapped in a linear income model. They work, they get paid, they spend, they need to work again. The cycle repeats. But once money begins working, even in a small way, the model changes. Now you have 2 workers. You have yourself and you have your capital. At the beginning, your capital is weak, it is small, it produces only a little. But if you protect it, feed it, and give it time, it grows. That is why the real benefit of the first $10,000 is not only the return, it is the change in how you see the game. Now, if asset allocation is simple, why do most people still fail? Because they do not have rules. They hear about a fund from a friend, they buy it, they watch a video, they buy something else, they see the market go down, they sell, they see it go up again. They chase. There is no plan, there is only reaction. This is how people turn investing into stress. It is like wanting to get healthy, running 10 miles one day, injuring yourself, then doing nothing for 3 months. The problem was not exercise. The problem was the lack of a sustainable system. Money works the same way, so if I had $10,000 and I wanted to build a simple system, I would divide it into 3 layers. The first layer is the safety net. I would hold 20% or $2,000 as emergency money. This money is not meant to be clever. It is not meant to chase return. Its job is psychological and practical stability. It can sit in a high-yield checking account, a savings plan, or a short-term deposit. The exact instrument matters less than the function. It must be safe, liquid, and available. Some people look at this and say, but that money is not earning much. Isn't that inefficient? Not if you understand its role. The emergency fund allows the rest of the system to function. It is like oxygen for the investor. If your car breaks down, a pipe bursts, you have a medical bill, or your income is interrupted, that $2,000 gives you time and flexibility. Many people do not fail at investing because they choose the wrong ETF. They fail because life happens and they are forced to sell at the worst possible moment. That is why liquidity matters. If you invest everything and keep no safety net, then one ordinary emergency can become an investment disaster. You sell when markets are down, you lock in losses, and then you tell yourself investing is too risky. But the real problem was not the market. The real problem was that you did not have a cash buffer. A good system respects reality. It assumes that life will be uneven. It assumes there will be surprises. It builds protection before it reaches for growth. That is why the first 20% stays safe. The second layer is the growth engine. This is the core of the allocation. I would put 60% or $6,000. Here, the job of this money is long-term steady growth. This is the part of the machine that compounds. This is the part that owns productive assets. This is where your money stops sleeping and begins working. In a simple structure, this layer can be divided between broad stock market ETFs and bond ETFs or investment grade bonds. One example is to put 70% of this growth engine into broad stock market ETFs, such as funds that track the global market or the broad U.S. market. Names like VTVU or VTI are examples of broad market exposure. The other 30% can go into bond ETFs or investment-grade corporate bonds. The stock side represents growth. The bond side represents stability. Stocks can deliver higher long-term returns, often in the 8 to 10% range over long periods. But they come with volatility. Bonds usually return less, perhaps around 3 to 5%. But they can reduce the emotional and financial shock when stocks fall. The purpose is not to eliminate risk. That is impossible. The purpose is to balance risk so that you can stay in the game. The biggest advantage of this structure is that it recognizes human nature. If someone goes 100% into stocks and then watches the account fall sharply, they may panic. If they panic and sell, the theoretical return never matters because they did not stay invested long enough to receive it. A slightly less aggressive portfolio that you can actually hold can beat an aggressive portfolio you abandon. That is why the best portfolio is not always the one with the highest expected return on paper. The best portfolio is the one you can stick with through bad headlines, market crashes, fear, and uncertainty. Now, once you have the $6,000 growth engine, do not obsess over buying at the perfect price. This is another trap. People think they need to wait for the bottom. They think they need to know whether next week will be higher or lower. They want certainty before acting. But markets do not give certainty. They give probabilities. Even professional fund managers cannot reliably time the bottom. So a practical approach is dollar cost averaging. Instead of investing the full $6,000 on one day, divide it across 6 months and invest $1,000 each month. This gives you an average entry price. If the market falls after your first purchase, you buy more at lower prices. If the market rises, you are already participating. This is not perfect. Nothing is perfect, but it reduces regret. And reducing regret helps you stay disciplined. A good system must manage both the math and the person doing the math. The third layer is the opportunity fund. I would keep the final 20% or $2,000 as flexible capital. This is not the same as the emergency fund. The emergency fund protects your life. The opportunity fund gives you the ability to act when markets create unusual prices. Think of it as ammunition. When the broader market falls more than 15% from its peak, that is the kind of moment when I would begin deploying this money in batches. Not all at once, in batches. Why keep opportunity money? Because when the market is falling, most people become emotionally weak. They see red numbers, they hear scary news, they think the world has changed forever, they sell or freeze. But if you have cash already set aside for opportunities, your psychology changes. Instead of saying, I am in danger, you can say, this is what my system was built for. That is a very different emotional state during major declines. The person with no cash feels trapped. The person with a plan feels prepared. Now, some people will ask, what if the market never drops and that $2,000 sits there earning only a modest return? That is the trade-off. You can keep it in a money market fund or a short-term ETF, maybe earning 2 to 3%. It is not completely idle. But the deeper benefit is optionality. Optionality always has a cost, but it also has value. The key is to know why you hold it. You do not hold it because you are afraid of investing. You hold it because you want to be ready when the odds become more favorable. So the $10,000 system becomes simple, a safety net, a growth engine, opportunity bullets. This is not complicated, but it is structured. And structure is what keeps you from making decisions based on panic, envy, or impulse. Now let us talk about execution, because a plan that is not executed is only an idea. The first step is to open a brokerage account today. That can be done online in a short period of time. You need your identification, bank details. You choose a broker with a clean interface, low fees, and easy access to ETFs. Many major brokers offer zero commission trading for ETFs, so the friction is much lower than it used to be. Do not make this step bigger than it is. A lot of people turn the first step into a wall. They compare every platform, read endlessly, and delay for months. But the purpose is to begin. You can improve later. You cannot compound what you never start. The second step is to set up automatic transfers. This is crucial because human nature is inconsistent. If investing depends on you feeling motivated every month, it will fail during stressful months. If it depends on you remembering, it will fail during busy months. If it depends on you making a new decision every time, your emotions will eventually interfere. Automation removes the decision. When money enters your account, the system moves a fixed amount into your investment plan. After a while, you adjust, the contribution becomes normal. You stop debating it, you stop seeing it as sacrifice, it becomes part of the machine. This is how good habits are built, not by relying on willpower forever, by designing the environment so the right action happens automatically. The third step is choosing the ETFs. Do not overcomplicate this. If you do not know what to choose, a broad total market ETF can be enough as a starting point. Funds such as VTI or VO are examples of simple broad exposure. The purpose is to own the productive engine of the market without trying to guess the next winner. There is no perfect fund, there is what fits the system. If you spend months trying to find the absolute best ETF, you may lose more from delay than you gain from optimization. Good enough done consistently often beats perfect. Delayed indefinitely. The fourth step is rebalancing. Rebalancing is one of those ideas that seems strange until you understand the logic. Suppose your target allocation is 70% stocks and 30% bonds. After a strong year in stocks, your portfolio becomes 80% stocks and 20% bonds. Your risk has changed. You now own more of the asset that has just risen and less of the asset that stabilizes the system. Rebalancing brings the portfolio back to the intended ratio. It may mean selling some of what went up and buying some of what lagged emotionally. This feels unnatural, but systematically, it is powerful. It forces you to sell high and buy low without needing to predict anything. Doing this once every 6 months is enough for a simple system. It does not require constant action. It may take less than 30 minutes. But it keeps the machine aligned with the risk level you chose. That is the point. You are not letting the market slowly turn your plan into something else. You are keeping the plan under control. The fifth step is to keep learning without overreacting. This distinction matters. You should keep learning. You should understand inflation, interest rates, broad market behavior, and macro shifts. You should know what is happening in the world, but learning is not the same as tinkering. If every article causes you to change your allocation, you do not have a strategy, you have a reaction habit. Retail investors often underperform the indexes by 3 to 5% because they trade too frequently and make emotional decisions. They buy after gains, they sell after losses, they confuse activity with progress. The best investment strategy is often boring: buy, hold, rebalance, keep contributing. That is all. And because it is boring, many people underestimate it. Now let us talk about potential results. Based on historical data, a 70 divided by 30 stock to bond portfolio can produce a long-term annualized return around 6 to 8%. This will not happen smoothly. It will not happen every year. Some years will be negative. Some years will be excellent. The average only matters if you stay in long enough to experience it. If you invest $10,000 at a 7% annualized return, in 10 years it becomes nearly $20,000. In 20 years, it becomes more than $38,000. In 30 years, it becomes more than $76,000. And that is without adding another dollar, but very few people should stop there. If you add $200 every month on top of the initial $10,000, over 30 years, the number can grow to more than $300,000. It does not look dramatic at first. It looks slow, then it becomes meaningful, then it becomes powerful. This is the part people struggle with. They want the tree to bear fruit the week after planting it. But capital does not work that way. It needs time. It needs consistency. It needs protection from emotional decisions. The slow early stage is not evidence that the system is failing. It is the stage where the roots are growing. But I also want to be direct. You will face downturns. You will see the account fall. There will be a recession. There will be a market crash. There will be a year when the headlines make intelligent people sound terrified. There will be a moment when your stomach tells you to sell. This is normal. During the pandemic crash in March 2020, many accounts fell more than 30%. That kind of decline feels terrible when you are inside it. It does not feel like an opportunity. It feels like danger. But if you have a system, the system tells you what to do before the fear arrives. If the market falls, you keep buying. If the portfolio drifts, you rebalance. If your opportunity threshold is hit, you deploy in batches. If nothing special happens, you continue the process. This is why systems matter. They reduce the number of emotional decisions you have to make. And in investing, reducing bad emotional decisions may be more important than finding brilliant ideas. Your biggest enemy is not the market. Your biggest enemy is the version of yourself that wants to abandon the plan at the worst possible moment. Now, there is another point that must not be missed. Investing is important, but your portfolio is not your only source of wealth. For many people, the greatest asset is still human capital. If you are 30 years old and earn $60,000 a year until age 65, that is more than $2 million in salary before raises. And if you increase your skills, build your network, gain experience, and raise your income, the impact on your financial life can be enormous. A higher income gives you more cash flow gives you more to invest gives compounding more fuel. This is how the machine accelerates. Do not become so obsessed with squeezing an extra 0.5% from a portfolio that you ignore the possibility of doubling your income over time. Your skills, career, reputation, and ability to solve problems are also assets. One person starts with $10,000, invests carefully, and stops there. Another person starts with $10,000, invests carefully, and also grows their income from $60,000 to $120,000. The second person can contribute far more every year, and the portfolio compounds much faster. That is why I see investing in yourself and investing in assets as complementary. They are not competitors. Your human capital earns the money, your investment capital compounds the money. Both matter. Now let us bring the whole system together. The first principle is diversification. Do not put everything into one idea, one stock, one fund, one moment, one opinion, or one emotion. Spread the risk, own broad exposure, let the system carry the weight. The second principle is long-term holding. The market will rise and fall. You do not need to predict every move. You need to stay aligned with your long-term goals and keep the process going. The third principle is disciplined execution. An average strategy executed for decades can beat a brilliant strategy abandoned after fear. Discipline turns a simple idea into a result. So with $10,000, the allocation can be clear. 20% or $2,000. Stays in the safety net. 60% or $6,000 goes into the core growth engine, such as broad market ETFs and bonds, deployed gradually over time. 20% or $2,000 stays flexible for opportunity, earning modestly while waiting for moments when fear creates better prices. Set up automatic transfers. Choose simple ETFs. Rebalance every 6 months. Keep learning, but do not overreact. Stay patient. This strategy will not make you rich overnight. It will not give you social media excitement. It will not make you feel like a genius next week. But it can give you something better. It can give you a real path. It can let your money work without forcing you to stare at charts every day. It can reduce anxiety. It can give you a process that survives market noise. And over 10, 20, or 30 years, it can turn a modest beginning into meaningful capital. That is the purpose, not excitement. Freedom. Now ask yourself, what happens if you do nothing? If you leave $10,000 idle in the bank, inflation keeps moving. It does not wait for you to feel ready. It does not ask permission. It simply reduces the buying power of the money you worked so hard to save. That is why inaction is not neutral. Doing nothing is also a decision. It is a decision to let inflation be the manager of your money. Taking action does not mean acting recklessly. It does not mean investing all at once without thinking. It means building a system that respects both risk and opportunity. When you first do it, you may feel fear. That is normal. Fear appears whenever you move from the familiar to the unknown, but after the system is set up, you will often realize that investing is not as frightening as you imagined. The account moves. Some months are up, some are down. The machine continues. You keep contributing. You rebalance. You watch the numbers slowly grow. Over time, the sense of control becomes more valuable than the exact account balance. You begin to understand that wealth is not only about having more money, it is about having more choices. The choice to handle emergencies without panic. The choice to take opportunities. The choice to spend your time differently. The choice to stop relying entirely on one paycheck. The choice to build a future with more room to breathe. That is what a $10,000 system can begin. It is not the finish line. It is the starting point. And if you wait until you feel completely ready, you may wait forever. There is always uncertainty. There is always a reason to delay. There is always a headline that makes the future look dangerous. But the future is always uncertain. That is why the system matters. You do not build a system because the world is stable. You build a system because the world is not stable. So do something practical. Look at your current assets. Ask how much can be placed into a safety net. Ask how much can begin working in a simple long-term portfolio. Ask whether you can automate a monthly contribution. Ask whether you can increase your income and feed the system faster. You do not need to do everything at once. Starting with $100 or $200 a month can still build the habit. The habit is the seed. The system is the soil. Time is the weather, compounding is the growth. The best time to invest may have been 10 years ago. The second best time is when you finally stop waiting and start building $10,000. May not look life-changing in the beginning, but used correctly, it can change the way you think, the way you act, and the way your money behaves. And once your money begins working for you, you are no longer only chasing money. You are building a machine. That machine may start small, but if you protect it, feed it, and let time work, it can become the reason the future version of you has more freedom, more confidence, and more control than the version of you who did nothing. That is the real lesson. Money sitting still is fragile. Money inside a disciplined system becomes a worker. And the moment you understand that, $10,000 stops being just a number. It becomes the first brick in a structure that can carry you for the rest of your life.